समझ नहीं आ रहा अपने सैलरी इंक्रीमेंट का क्या करूं।
बेटा इतना क्या सोच रहा है? अपने म्यूचुअल फंड्स के एसआईपी का टॉप अप करा ले। दिस इज द राइट टाइम।
क्या? समझ में नहीं आया।
बेटा इतना क्या सोच रहा है? अपने म्यूचुअल फंड्स का एसआईपी टॉपअप करा ले। दिस इज द राइट टाइम।
अब समझा।
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.
Hello and welcome to ThePrint. This is Bidisha and you're watching Economics. Last week, the Reserve Bank of India took a policy decision that confused many observers. It kept interest rates unchanged. The repo rate stayed at 5.25% and the RBI retained a neutral policy stance. Markets were not entirely surprised, but the question still remains that if inflation has cooled so sharply, why didn't the RBI cut rates? To answer that, we need to look beyond the headlines and actually look at what the inflation numbers are exactly telling us. Let's look at the first chart on your screen. This shows India's CPI inflation over the past 2 years along with the RBI's comfort band. You can see the story very clearly. Inflation spiked above 6% in 2024, driven largely by food and supply shocks. Then it fell sharply. By early 2025, inflation drops below the RBI's 4% target. And by the mid of 2025, it falls even further, close to 2%, and briefly even lower. But notice how inflation falls. The sharp disinflation you see here is being driven mainly by food prices and base effects, not by a collapse in demand. And this is very crucial because the RBI has seen this movie before. India has experienced supply-driven disinflation many times over the last 2 decades. Whenever food prices correct sharply because of a good harvest, temporary supply fixes, or favorable base effects, headline inflation drops very quickly. And then, just as quickly, it returns. We saw this in the mid 2000s, we saw it again around 2014, 2015, and we saw similar patterns after pandemic-related supply disruptions eased. Each time, inflation fell for reasons that had little to do with sustained weakness in demand. And each time, that relief proved to be temporary. This history explains the RBI's caution. Central banks don't just ask, is inflation low? They ask, is it going to stay low? And supply side disinflation rarely offers that reassurance. Food inflation in India is volatile by nature. It responds quickly to weather shocks, to logistics disruptions, to global price movements as well. So when inflation falls mainly because food prices are behaving, policymakers hesitate to declare victory. Cutting rates aggressively at this stage risks boosting demand just as supply side pressures return. That's exactly why the RBI is not treating today's low inflation as a permanent shift. Headline numbers look comforting, but the underlying risks haven't yet disappeared. This brings us to the second chart. The chart that you see on your screen compares two things: the repo rate, which is the RBI's policy signal, and the WALR, or the weighted average lending rate, which is what borrowers actually pay. And the gap between the two tells an interesting and a very important story. When the RBI cut rates aggressively after the pandemic, you can see the repo rate fall quickly. But lending rates did not fall by a similar amount. And then, when inflation surged after 2022 and the RBI raised rates, banks passed those hikes on very quickly. Now, fast forward to today. Inflation has cooled sharply, as we saw, in the first chart. But borrowing costs continue to remain elevated, as the second chart shows. This tells us something very crucial. The problem isn't policy intent, it's the transmission that is the main issue. Interest rate changes don't reach the economy instantly. They work with lags. Bank lending rates adjust slowly, corporate borrowing costs take time to fall, household EMIs don't come down overnight, and in India, this transmission is asymmetric. Tightening passes through fast, easing passes through quite slowly. So, even though inflation is low today, many borrowers are still facing high interest rates. That means cutting the repo rate again right now may not provide immediate relief, but it could increase inflation risks later. So, the RBI is pausing not because it doesn't want to support growth, but because it wants to see whether earlier easing is actually reaching the economy or not. Now, the question is, why is this pause deliberate? This is exactly where the neutral stance matters. Now, let me clarify. Neutral does not mean inactive. It does not mean uncertain. It means flexible. The RBI is watching closely. Are lending rates finally responding? Is credit reaching productive sectors? Or is easy money just inflating asset prices? In monetary policy, timing matters as much as direction. If you move too early, you lose control. If you move too late, you lose credibility. Right now, the RBI is choosing to wait deliberately. There's one more layer to this decision. The global economy has changed, and it has changed structurally. We are no longer in a world of stable trade rules and predictable supply chains. Tariffs are rising, geopolitics is reshaping trade, supply chains are being reorganized for strategic reasons, and for India, this matters enormously. Tariffs and trade disruptions act like cost shocks. They raise prices without even increasing demand. That's the hardest kind of inflation to manage. So, even if inflation looks calm today, global pressures can reappear very quickly. If the RBI cuts rates aggressively now, it would have less room to respond later. In uncertain global conditions, policy flexibility is very valuable, and a neutral stance preserves that flexibility. By holding the repo rate at 5.25%, the RBI is typically buying time. Time for supply side disinflation to prove durable, time for lending rates to respond to past easing, and time for global uncertainties to settle. Sometimes, the most important policy decision is knowing when not to move. And that's exactly what we are seeing here. That's all for this episode of Economics. Thank you for watching.